you heard of a REIT? A REIT is a real estate investment trust, and it's basically liquid real estate. If you think about investing in property, one of the biggest problems with investing in property is A, the liquidity, so selling it quickly or getting out of your investment is quite tricky. And the second issue is being diversified enough. So, if you want to invest in real estate, do you really want everything tied up in one commercial building in one city? Or would you like to be in hospitals, industrial units, commercial property, residential property? Would you like to be exposed to the UK, to the US, to Canada, to Australia, to China, to lots of different countries? And REITs are a great way of doing this. So REITs are basically real estate sitting inside a publicly listed trading company. They have to distribute 90% of their profits as dividends every year, so the rental income that property generates is returned to shareholders in quite an efficient manner, and it can be a great way of getting diversification across lots of different real estate classes. Interestingly, they also qualify for margin. So, when you buy a piece of real estate privately, you can obviously put a deposit down of 30% and you can borrow the other 70%. Well, you can do the same with a REIT, but the difference is instead of having a mortgage where you're personally on the block, with margin lending, you only risk the real estate investment trust. You only risk the shares that you've bought. So if it all goes wrong, they take the shares away from you. The other advantage is margin lending is much, much cheaper. So, for example, you can get margin lending on euros at the moment for 0.7% a year. Yes, per year. So, the 6 or 7% return on the real estate that you're getting is very, very efficient when you're borrowing money at 0.7%. So real estate investment trusts can be really interesting from an investment portfolio perspective. But we're also exploring how we could use them for our own listings. So we're listing a REIT right now on the London Stock Exchange. We will be using that as a home for the real estate that sometimes comes with businesses that we buy. So when you buy a business and it has its own real estate, it's quite an old-fashioned idea for a business to still own its own real estate. But when they do, it can be a little bit of a tricky thing because quite often the real estate is worth as much, sometimes more than the business. So you have this big lumpy asset sitting there, which kind of skews the valuation and skews the return on capital employed. So the idea is that you can carve the real estate out into the REIT. That gives the real estate owner liquidity because they can sell a bit of it or they can keep it. They still get the income through the dividends on the shares, and the business can be spun out into a different transaction. So effectively, it's a way of carving out the real estate and the business in quite an effective way. So REITs definitely something you should look at from an investment portfolio standpoint because they give a really good return on capital. It's a great way of passively involving yourself in real estate. It's kind of real estate investment without having to fix the boiler, and also really worth looking at from an exit perspective, a way of exiting businesses that own their own real estate.